Good afternoon, this is Michael Douville in Scottsdale, Arizona, and I just need to get the disclaimer. I am not a licensed stock and bonds broker, nor am I a licensed financial advisor. However, I am a real estate broker here in the state of Arizona. Have been for over 30 years, and I'm done quite a bit of investment work. I'm not a economics professor, but I certainly am reasonably well versed in investment vehicles. And a couple things that have come to mind. I've been talking about economics and some of the markets. I do want to bring this to your attention. I read an article today by Meb Faber Research. I want to give them credit for that. And they were mentioning a graph that was put out by Ned Davis Research, and it was a ratio. It was called the sales to price ratio of the S&P, and they mentioned that if you had a ratio of 1.53 and above, the expected return for the assuming for the next 12 months was 0.6. If it was under 1.53, it was 6.6, and if it was really low, like it was in 2009, it got down all the way to a 0.7 ratio. The expected return was over 10%. And the reason this graph is so important is that it is now 2.2%. It's at the very highest it has ever been in its entire lifetime. It's at a historic high. So what does that tell us? It tells us that, gosh, that's just another red flag. You know, when you have investment greats like Bill Gross and Stanley Druckenmiller, Jeremy Grantham telling you that, hey, you know, it's starting to get to the point where the party might be over, you know, it's really time to start thinking that you need to really pay attention to this. I've been saying that to be prudent, you need to start considering taking profits. Now it's starting to get to be common sense. So if you have huge profits in the stock market, I, for one, have already protected mine, and I've gone to take an awful lot of my cash off the markets, or out of the markets, and we're down to strategic properties, and we've got very, very good properties that are holding most of our investments, and we're sitting in cash. I'm going to recommend to you once again that common sense tells you that when you're at these lofty levels and you're getting red flag after red flag after red flag, and you're having some of the greatest investors in the world, even George Soros is saying that he thinks the party might be over. So we need to just start thinking of it. Maybe it's prudent, maybe it's common sense to take some of your investments off the table. So that, where does that leave you to put that money? Well, you still want that consistent monthly income. I'm going to recommend to you that you need to leverage some of that money. If you took a third or half off, I would go buy some property with that. And I'm going to tell you that I think that you can start to see some interest rates creep up. I still expect them to stay reasonable. But are we going to look 3, 4, 5 years outline, 10 years outlying? What do we think the rates are going to be? I think they're going to be significantly higher than what they are now. So my advice to new investors, if you want to call me, we're more than happy to help place your money. But if you're local, you can find things typically in your local area. Unless you're in an extremely high rent district, then you need to start thinking of a market like Phoenix here. We're expected to be the number 1 and number 2 growth market for the next decade. So it's certainly love your business, but you don't necessarily have to bring it here to Phoenix. I'm sure there's something near you. But if you start thinking 4, 5, 6, 7 years outline, I think that you need to start thinking putting mortgages on properties that you own. I don't think you're going to get rates like this ever again. Maybe well, I shouldn't say. Maybe we'll get that back in the next next 6 months to 12 months. I don't think you have to race right up, but I would certainly leverage whatever I bought. So if you and I do it judiciously. If we took $1 million off, we would certainly want to leverage that and put no more than 30 or 40% down. So and leveraged 60-70% only. We want to make sure we have good strong cash flow and a good strong conservative position. So my advice to you is here: let's get some profits off the market, and I think that you're going to be really well served if we can get some real estate, which is in a different asset class than the stock and bond market. It beats to just a little bit of a different drummer. And if we can get you into some cash flowing properties, you will be so well served. you will be so happy that you have consistent monthly income coming in, and I think that could be your lifeboat. So here again, you're welcome to call me. I do pick up my phone. I'm available. You'll have to set an appointment. We sell income producing properties. We still even have some private placement opportunities still available, although you do need to be a qualified investor. So let us know, but we can certainly design a cash flow stream for you, and whatever happens, it'll protect you. If we do have a problem, then you'll be protected. If we don't have a problem, your properties will just continue to grow and cash flow and serve you well as well. So there's really no downsides to that at all. So I'm going to wish you the best, and give me a call.